see if anybody joins us. So I am going to actually minimize what we're doing here. So
Okay.
oops, I cannot do that. Never mind. Hold on. I'm just going to pull up the Facebook one. Okay. Well, I would like to welcome today, excuse me, Miriam Gilmore to our Facebook How to Be a Money Master free community, where we are going to discuss all things mortgages. So mortgages, refinances, all of that fun stuff. And so please, I did put a link to the Zoom room down in the comment section below. And so, please hop in there, because then you will not have the delay that we're currently having on Facebook. And on top of that, you'll be able to freely interact with us. And so welcome, Miriam. Miriam is actually the one who I go to when I have mortgage questions. She's my go-to person. So she really knows her stuff. And she is located in Miami, right?
I am in Miami, Florida. Mm-hmm.
And you can do like a mean, you sounded just like Sophia, what's her name? The one from, when you did your video the other day. That was, yeah, that was absolutely hilarious. So
it was fun making it, yeah.
Yes. So welcome, Miriam. Thank you so much for joining us. We're so lucky to have you in the group. And
well, thank you so much for having me. I'm excited to talk to everybody in the group and get to know people a little bit better, and hopefully answer some of those questions, because mortgage financing is one of those things where you really only do it a few times. I mean, some people might only do it, maybe once or twice. So it's really not something that you like do all the time. So it's that if you're not in it, it's always a mystery, and there's always questions. So I'm happy to clear up some of that mystery for people.
Yes. Well, once again, thank you. I really do. I appreciate you volunteering to come on to talk to us today. I do have a quick question. So I guess we'll start right off with mortgages.
Yeah, let's go.
I do have a couple of questions from one of our members, who is a young lady who is getting ready to purchase her first home.
Yay.
And yes, and so she's graduated from college. She's been saving some money. She is currently debt-free. I know that she has a major credit card that is paid in full. She has paid off her new car loan.
Nice.
So she has a good credit score. And she wants to know how she can have a low down payment and stay away from PMI. Is that even possible? I mean, I know the general rule of thumb is anything under 20% equity, you have PMI.
Yeah.
Can that be avoided?
It's kind of tough. Typically, rule of thumb is anything under 20%, there's PMI.
Okay.
So it would be difficult to go with like a 3% or a 3.5% and not have PMI. So if you're going to go, say, FHA, just even if you put 20% down on an FHA loan, typically you'll have PMI insurance. That's just the way that product is just incorporated into that product. However, in a conventional loan, like we discussed, 20% down, you wouldn't have to have PMI. I think the only way that I've seen for somebody not to have PMI is if they would get a first and a second. So a first mortgage with like, at that 80%, and then a second to like 15%. And then that way maybe avoid the PMI. And then you do 5%. But that comes with some challenges, because not every lender will allow, in other words, second mortgage lenders, they might not go to 95%. What they call LTV, which is combined loan to value.
Mm-hmm.
So it's just one of those things that it just depends on the broker you're working with or the lender you're working with, and what product they can find for you. However, I will say with with mortgage insurance, home values are appreciating so rapidly. If you went into a mortgage, like I have customers that maybe bought a house 3 years ago, and if they wanted to refinance today, it's a good idea, because one, the rates are lower from when they bought, and two, the value has gone up, so their equity has built. So now their loan's an 80% loan to value, and we're getting rid of their PMI insurance and reducing their payments.
Oh, that's wonderful. Now, do they have to pay for an appraisal in order to show that the value has increased to the 80% mark? Or
typically, yes.
Okay.
Typically, yes. However, there's something new with Fannie Mae. that just came out where and it's kind of random when you run the approval. If the system generates a non-appraisal, is like an appraisal waiver, then you don't have to. And that's new. I had never had that. I already closed my first one without an appraisal, which was pretty cool.
So how do they figure it out then?
They I guess they use the what do they use? The data, the information that they get from the market. Oh my God, the property appraiser's office. I don't know exactly how that happens, but
okay. I would say, are they like pulling the comps from Zoom or something, or not Zoom, Zillow? Are they?
I'm sure they're not using Zillow comps,
okay.
but I'm sure they have some way that they have determined these amounts, and they're able to decide. And I guess it has to do with your loan to value also. Like if you're like at a, it has to be below an 80% that they wouldn't ask for that,
Yeah, no, that's very interesting. I had never heard of that one before.
But that's new. So. Like before, it was everybody had to have one. Now it's like random.
Right. And when it comes to PMI, one, could you explain what PMI is? I know you've already said it's basically insurance, but also, is it something that's a standard? Is it a standard fixed rate across the board, or does it depend on who the lender is? How do they figure out how much the PMI is going to be?
So basically, okay, so let's just discuss what that is altogether. So mortgage insurance is basically an insurance that's required when you put less than 20% down, right? Now that insurance is not really covering you as a borrower. That's covering the bank, the lender, that they're giving a loan with less than 20% down payment. So it's kind of like you're paying for somebody else's insurance, but they're also lending you the money. So, so that's good. And then as far as the rates, so FHA has a different pricing for their mortgage insurance, and it's like a government funded, so it's a little bit less expensive. It's about, I want to say it's 0.85 versus your traditional mortgage insurance. And then there's mortgage insurance companies. So there's different companies, and they're almost the same as a bank where they underwrite your loan, and the rate really is determined by the credit, your loan to value, all the different factors. The same as your bank is underwriting you, this PMI mortgage company is also underwriting you to a certain extent. It's not as deep as a mortgage underwrite, but they do. And so those rates are also affected by those things: loan to value, debt, credit score, and that type of thing.
Okay, that's very interesting. And I know. Yeah, obviously we're talking. These are only available in the U.S. I'm guessing they have different things for Canada, Mexico, Europe, et cetera, et cetera. So I'm sure it'll just be a matter of finding out the details. But I would think they'd be similar. So if you understand the concept, you can just find out what the name is called in your particular country if you're outside the U.S.
Yeah, it's funny because I've dealt with people who are from other countries who are buying second homes here, and it's pretty amazing because a lot of my customers that are foreign nationals, they don't have mortgages. It's just not a thing.
Really? Wow.
Yeah, like it's different. And in Latin America, a lot of people just they just don't have mortgages. Even in Europe, I mean, maybe some more in Europe, but in Latin America and South America, I'm like, pretty cool.
Yeah. I do know. It seems like a lot of people I speak to in Europe, they tend to rent, or they'll, I don't know, some will buy an apartment though, because, but yeah, just because the values are so much higher and it's cheaper to rent. It's like flip flop from here. We're here a lot of times, especially right now with our market being what it is. Yeah. It tends to be less expensive to own than to rent. And over there, it's like the opposite. So there's definitely a lot to keep in mind. So now I know we've been talking about a lot like FHA, Sallie Mae, Freddie Mac. Is Freddie Mac still around? Freddie Mac's still around, right?
Freddie Mac is still around. Yeah. Okay. And Sallie Mae is student loans, right? So
yeah. Oh, that's right. No, what was the one that didn't you just say one though?
FHA.
Sorry. Yeah, FHA, and then what else? What are the other ones that are available? What are the other programs that are available?
There's Fannie Mae.
Oh, Fannie Mae. Sorry, Fannie Mae. I got the wrong May. Oh my gosh. Yeah, sorry, Fannie Mae. So we have FHA, Fannie Mae, Freddie Mac. So what are the different programs and just a basic overview of who might qualify for them?
So when you talk about, so FHA is your government, they call it Govy in the industry.
Oh, okay.
And that's, so that would be, FHA, VA.
Okay.
And those are more government-backed mortgages, right? And that type of mortgage is more when you talk about an FHA mortgage. So a lot of times what they allow. So when we're talking about debt to income,
Mm-hmm.
basically when you're doing a conventional loan, which is Fannie Mae, they allow to 43% of your income to be to debt. So whatever your income is, 43% of that is the max that you can owe between your debt, your mortgage, all of your, all of your expenses.
So your credit card, your auto loans, your personal loans,
Yeah.
your student loans, they go in there too?
It is,
Student
unless they're
loans?
deferred. Unless they're
Okay.
deferred.
And the mortgage that you're going to be
Yeah.
taking out. So you take all of those minimum balances and they have to be less than 43% of your, is it your gross income or is it after tax? Okay, so your gross income.
Gross. It's gross.
Okay.
Yeah, it's gross. And by the way, 43 is a standard, but they'll go to 50 if they have to.
Okay.
Right?
So basically for people who don't like doing a lot of math, if you're making $1,000 a month, you have to make sure that your minimum payments, not necessarily what you're paying, but your minimum payments are less than $430 per month for all of those different types of debt. Okay.
Yeah. So yeah, and that's including your mortgage, your mortgage payment or your rent payment or whatever. So
And
that would
insurance too, right? Your mortgage would include your insurance and taxes.
Yeah.
So, okay.
Yeah. So all of those things, they'll go to 43, and they'll push it to 50 if they have to, but they might say, okay, you have to have in the bank when you do your closing 3 months of reserves if we're going to go over 43 or something like that. So they've softened up those rules a little bit, and that's been in the past couple of years. So FHA, I guess is for the borrower who has a little bit more debt and maybe a lower credit score.
Okay.
So they'll do 3.5% down payment, and they'll allow you to go up to 56% debt to income ratio.
Okay.
So for people who have a lot of debt and maybe they have the income, but they do have a lot of debt, and they're putting a low down payment, this is a program that'll work better for them. And the rates are favorable.
And is there a minimum credit score for that loan?
The minimum credit score is about a 580.
Okay.
They'll go down to maybe a 560 or 550, but I mean, then you have, there's overlays. So if you have a 550, then they're not going to lend you 56% debt to income. You're going to go down to a 43. And then you have to have reserves. So there's overlays, like if something's not, like typical, then they might make exceptions, but then there'll be some rules to that exception.
Okay. That makes sense. So you can't have it all, right?
Yeah, right.
Okay.
That's where it helps, it's really beneficial to have a credit, especially if you're going to do FHA, at least be above a 600.
Okay.
And there's not those overlays, you can still go to a 56 DTI.
Okay, wonderful. And then we get into, so we've done the FHA and the conventional, so then we get into the Freddie Mac and Fannie Mae.
Yeah, so conventional, same thing. If you're putting, with Fannie Mae, there's programs where you put 3% down, depending on areas and that kind of thing. So there's a lot of options with that. And the advantage of a Fannie Mae loan is that if you do have mortgage insurance, when you get to the point where you're at 80% loan to value, you don't necessarily have to refinance out of that loan. You can just simply call your lender, say the value's there, and they'll come out and do an appraisal that you'll have to pay for. But you don't have to go through an entire refinance. If you have a good interest rate and you don't want to go through the whole process, they'll remove the PMI.
Oh, and that's good to know, especially because the interest rates are pretty low right now. So, that's very encouraging. So why would someone choose an FHA over the Fannie Mae?
They might choose it because they have high debt.
The high debt, okay.
Or low credit score.
Ah, okay.
Because below a 640, you're probably going to be better off with an FHA loan than with a conventional.
Oh, okay. Okay.
Yeah.
And then I know you also mentioned the VA loans, which I actually would qualify for, so I'm a little familiar with them. But
yeah.
I know we have for our veterans in the audience. So
sorry.
I said for our veterans in the audience.
Oh yeah. So I haven't had a lot of. I've done maybe 2 veteran loans. But basically the nice thing there is, and I'm sure you know this, that they give you 100% of the loan amount, and then you have to cover your closing costs unless you get some sort of a grant or something that'll help you with that. But it's a really nice it's a nice program. it's a nice loan.
Yes, they do have some high closing costs though with that. I found that I did check into it. At one point, I ended up actually going with a conventional loan instead of the VA loan because when I looked at the overall package, the conventional loan was actually the better deal.
It made more
Um,
sense.
yeah,
Yeah.
yeah, mostly because of the closing cost they tacked on there. I couldn't remember. It was a very, very high amount though.
Yeah,
And I
they
was
have
like,
like a funding fee that's like 1% or
yeah,
something like that. Yeah. Yeah.
yeah. So, but it is definitely, and especially if you're going to do new construction, which I know we haven't even touched that one yet, but
Yeah, yeah,
you know,
yeah.
there's a whole thing there too. So,
Yeah.
but okay, wonderful. Have we missed any then, or or wait, we still have Freddie Mac, right? Did we talk about
Freddie
him?
Mac is the same pretty much as Fannie Mae, and
Oh, okay.
it's basically their underwriting and the way that they approve a loan is a little bit different. So sometimes, for example, I'll run a loan, say a self-employed borrower, and self-employed borrowers sometimes, it's tough because you're self-employed, so you don't want to pay a lot of money on taxes. So people will be like, they'll they'll deduct everything under the sun because they're trying to pay less tax wise or whatever. And sometimes that shoots, that works against them because then when they're going to go buy. So they might have a really poor, tax return from the year before, and then they have a very good year tax return, from the second year.
Mm-hmm.
And so Fannie Mae, we have to average 2 years. Just that's the way it is. There's no going around it. With Freddie Mac, sometimes depending on credit score, down payment, and everything, they'll let you use 1 year of tax returns. And that is a deal saver for a lot of people because then we don't, if you imagine if you average a year where you declared you made 24,000 and then the second year you made 50, if you average that into 24 months, then it goes down. But if you just use the 50, you're going to be in a way better place.
Right. And I've actually seen that with my rental properties because there was one year where I actually flipped both of them. I put a lot of money into both, fixing them up and making it, doing updates, things like that. And so, yeah, for that 1 year, the profit for the tax return was very, very low, even though it bounced right back and it was actually worth more. So it was bringing in more money the following year. But, when you look at the tax returns, if you average it out, especially, it was not very, very nice. So, yeah,
Absolutely.
So, okay, wonderful. Is there anything else that I should be asking you I'm not thinking of?
I think because of the time of the year, it's tax time. I think that if anybody is thinking of buying or whatever, or they want to make a plan out one day to be able to buy, looking at that tax refund and doing something really smart with it,
No,
either paying off debt. Or maybe depending, I don't know what the tax return might look like, but if it's something where you might want to put that away for your down payment, or closing cost, that type of thing.
Yeah, that's a great idea.
It's a great way to start. And, some people, you get $5,000 back, $3,000, whatever. That's a nice chunk of change.
Yes, definitely.
Really tough to pay off credit cards. It's tough to do that. But that's a nice, way to pay that off and reduce your debt to income so that when it comes time, your debt to income looks better.
Yes, yeah, no, those are great tips. I love that. So, and then another thing that maybe you could talk about is what what programs are out there. I know in theory I've talked before about people buying a multifamily up to 4 units, and that way they can live in it and rent it out and it, so how does that apply practically though? In real life, does that work out? Have you dealt with that a lot, or?
It's funny that you asked that because I have somebody right now and she's a real estate agent and she wants to buy a 4-unit place and she wants to live in one of them and rent out the other 3. And the nice thing about that is where if she's going to buy this and she's going to live in one of them, is that to help qualify, if your income isn't that great, the other 3 units, as long as they're rented and we have proof of rents and proof, in the appraisal and everything's, documented, that income can be used to supplement the income, your debt to income. So it would help you, it could potentially help you qualify for a loan. That's a little bit risky in the sense that, if one of your tenants leave and you don't have enough money, but if you plan it out correctly and you have a reserve, I think it's a great opportunity to be able to do something like that.
Right. Yeah, you definitely, once again, you have to kind of look at the whole picture and look at it. But no, that's interesting that you've actually had that come through. Because like I said, it's one of those things that I've heard of it in theory. I've never known actually one who actually did it in real life.
Yeah.
So.
So I do. It's funny because this lady's like really interested, and she sent me, numbers on a couple of them, and I'm like, yeah, I think it might work. And their income was like not great last year.
Wow.
So I'm, it's a tight situation, but I think the numbers might work for her. As long as she keeps it under a certain price.
Does it matter whether it's already rented out, or if it's just, can they base it on what the market values are for when it's rented out, or how's that work?
No, they have to be rented out
They have to be
because
rented out to the account. Okay.
it could be, if theoretically you don't see, if you qualify for the loan without that income, then you're fine.
Right.
But if you need that income to qualify for the loan, then they have to be rented.
They want to see that. Okay. Wonderful.
Yeah.
And then another question that I received was they want to know how to get pre-approved for a mortgage.
Okay. That's a good one because there's pre-qualified and then there's pre-approved, right? And I'm sure you've heard those. So when somebody tells you I got pre-qualified, and I've talked to many people who have called me and they're like, oh yeah, I'm pre-qualified for $300,000. And I'm like, really? Tell me a little bit about it. And then I start to listen, and they tell me that their credit wasn't pulled, and that it was basically like a phone conversation, and they told the person on the other end in one of the big box lenders, I make this much and I have this much debt. So then they believe that they are qualified for a $300,000 loan. But then when they, come over to get actually pre-approved, it's different because a pre-approval is a full, it's pretty much, without going into underwriting, everything is getting looked at. So I'll ask you for your last 30 days of pay stubs, pull your credit. I want to see, your checking, your savings, if you have a 401k, all of your documentation. If you're divorced, I ask, do you have child support? All of those things into account so there's no surprises. And I give you a pre-approval letter, so you can go with that pre-approval letter and make an offer on a house. It's important to have a pre-approval because you definitely don't want any surprises. Once you're in contract and you have a deposit of $1,000, $5,000, $10,000, and now you're not sure because you never mentioned to the broker or the mortgage broker person that you have, a $500 child support payment, or that you have, oh yeah, I make $5,000 a month, but you're self-employed, and realistically speaking, what you declare is $2,800 a month. So you want to make sure all those things are looked at before you even go out to see property. That's what I would say.
Okay. And once I know a lot of people, they want that kind of pre-approval letter from the bank before they will even, they want it attached to the offer.
Sure.
So once you have that in place with the bank, is there a chance, like say for example, you're approved for a certain amount, and is there any chance like along the way that something could happen where all of a sudden you would not be approved when you actually were approaching closing?
Yeah. Yes, I can think of a whole bunch. So I've had borrowers, we're going through the process, and they buy a car in the middle of all this. I'm like, oh my God, you can't buy a car. No. Or they apply for credit cards, or they went to Rooms to Go and they bought like, a beautiful living room before closing. Those things will definitely be a problem unless you have your numbers, you're not tight and you can afford it. But when your numbers are tight and if you change jobs, sometimes that could potentially be an issue. It might not be, but sometimes it can be. If you get fired or quit your job, that would definitely be a problem, and that's happened. So things like that can be a problem, if something comes up. If I'm trying to think of things that can occur, but if the appraisal doesn't come in at value, those are some hiccups, because all of a sudden now you're buying the house, let's say for 300, and the appraisal came in for 285. Oh, now there's an issue. You have to renegotiate, and so those types of things are the things that can create you to not be approved at that moment.
Okay. So basically, once you start the process, you almost want to freeze your life as best as you can so that there are no real changes or surprises.
Yeah, I would say, not to make any major purchases. And it's funny because I have, and I just implemented it into my milestones, I call it, with my borrower. So
Mhm,
um, when I collect the initial documentation from my customer, or I send them the request for documentation,
mhm.
I send a video, and the video, it kind of explains what I'm asking for. And it also says, please do not make any big purchases. Don't apply for credit cards. Don't quit your job. Don't
Right.
go back car, like that type of thing, because it's a big deal.
Oh, yeah, yeah, it sounds like it. So,
Hmm.
and it makes sense because, yeah, if you can't just change the terms midway through. So,
Yeah. Hmm.
um, yeah, it's no surprises.
No surprises, please. There's a
Yes.
hilarious meme, and I think it's Kevin Hart with his big eyes like just coming out of his head, and and the meme says on top, when your borrower calls you with the great news, you just bought a new car, and you're like, ah.
Yes. Wow. Yes. Yeah. Now, how soon can somebody, say, for example, with the person who asked these questions, where she's getting ready to graduate from college, she's going to be starting a new job. How soon after getting that new job would she be able to apply, or even consider getting a mortgage? Does she have to wait a
Well,
certain amount of time?
because she's graduating, and she has transcripts and all of that, that would work for her. So say tomorrow she got a job at a hospital doing whatever it is, as a nurse. Let's say she went to
Mhm.
nursing school. Immediately she could be able, and she's hired, as long as she's had her, first paycheck. I would say maybe a month after, so at least you have 30 days of payment. Of,
Okay.
but pretty much immediate. And the underwriter might say, okay, we want to see your transcript that you just graduated, like say 2 months ago, and you're in a job now. So that
Mhm.
would be suffice. So that wouldn't really count as what they call gap in employment.
Okay.
We're going to school. So, and typically you'll have an offer letter from the employer, and,
Right.
you know,
Yeah. I know at certain levels you do. You have you get your offer letter and you sign off that
mhm.
that you accept the offer and
Yeah.
but I know
If you
at some
don't
of the
have
lower
that, I would
levels you
say
don't.
30 days of payroll,
Okay.
and your transcripts from your graduating class.
Right. And I would think that they could also probably get a letter from their employer stating that they were hired and that they're intending to, keep them for
Yeah.
X number, at least a certain amount of time or whatever. So,
Right. Yeah. Well,
it's not a
they might
temporary
require,
position.
they might ask for a verification of employment, and then in the verification of employment, it actually says, likelihood to continue employed, and they'll check off.
Okay. Okay.
Mhm.
Wonderful.
Yeah.
And so, what are the other types of mortgages that are available? I know we've mostly been talking about, buying, I guess, an existing house. What do we have if we want to do, if we want to build a house or we want to buy a mobile home or maybe some
Mhm.
other, I don't know if there's any other like alternative types of housing
Yeah.
that might have, little quirks in there.
Yeah. So there is construction loans,
Mhm.
okay, and then there are, which they would finance the construction. You always have to have some skin in the game, so you have to buy, at least have some money in the lot.
Okay.
Um, but a lot of times they'll finance. Typically, it's like 80%, and maybe up to 90% of the after value construction costs.
Hmm.
So that gets a little tricky in there, but there is construction loans, which they have there's some nice products which are called one-time close, so you don't have to like have a construction loan and then do a like a 30-year loan. So this is a
Okay.
one-time close, and the rate might be a little higher, but it's a one-time close, so it's kind of nice.
Okay.
So
Okay.
that's one loan. There's another loan which and you might have seen a flyer that I put out, and it's a renovation loan. And I think that is a very interesting loan, because it's either you can use it as a refinance or even to purchase. So I'm
Really?
actually, yeah, working on one right now that's a refinance, and they're adding on a great room. And the way that this loan works is that the bank will have the property appraised for the after value.
Oh, okay.
So say the house is worth 250, and adding on that great room will give it another $50,000 value. So
Hmm.
now that's a 300,000, and they'll lend you up to 90, I want to say it's 95% of the value.
Wow.
So, basically it'll cover everything, and you stay in the home, and you get it's a really good program. And they also have it for a purchase. So, you know, I've been talking to realtors and I'm like, if you're selling a house with an ugly kitchen, that big funny thing that everybody says is an ugly kitchen, this is a great selling tool because, you know, somebody could buy it, get a loan for the after value when the kitchen is done, and they could do it at their own style, however they like it, in the white marble or whatever they like. I don't know.
Right.
And it's, you know, it's a really good loan product. And what they do is they put the money for the construction or for the renovation in the escrow, and you go taking the draws. And then there's like a representative from like a independent representative. They call them a rep. And that person is kind of like monitoring the job. You have to get the contractor approved, but it's a nice loan and it's not a lot of out-of-pocket expense. I think it's great.
Yeah. It sounds like that'd be great too if you're buying a fixer-upper.
Yeah, for sure.
Now,
they'll even let you put a pool in.
I'm sorry, the what?
They'll even let you put a pool in.
Really? Oh my gosh. That's wow.
Yeah.
Yeah. So now, would they allow you to do your own work with that, or do you have to work with approved contractors, or how does that work?
So I believe so FHA and Fannie Mae allow this loan. So I think an FHA, and I'm not 100% on this, but I think you might, because FHA only allows for $35,000 in work. Maybe they would. I'm not 100% sure about that. The people who I've been working with have a contractor and an architect, but I'm not sure. You know, I'd have to look at that. That's a good question.
Yeah, I'm a do-it-yourselfer. So as you can see from my house, I've been working on my house and for the last 12 years, and it's getting there. But little by little, doing it myself.
It's always a project having a home, isn't it?
It really is. But I've done everything from I've redone the plumbing, I've rewired the entire house, I put in insulation, sheetrock, light fixtures, electrical outlets.
Yourself?
You know, so yeah, I mean, my stepfather helped me with the bathroom because that was like a major. At the time when I bought the house, I only had one bathroom, and so we actually stripped it down to nothing, and we spent 3 weeks just nonstop.
Amazing.
Yeah, for 2 weeks we actually had a bucket in the backyard. You know, it was like because there's no toilet. You know.
Oh wow.
And yeah, so it was quite the project. But yeah, for the most part, I've done quite a bit of myself. My daughter helped me with some of the things, especially when I need like that second pair of hands. But yeah, luckily I'm able to do plumbing and electrical myself, which is saved a lot of money.
Sure.
But that's why I'm curious to see, because if I were to be in that situation, I wanted to buy a fixer-upper.
Yeah, well, I'll find out.
Let me do as much as I can myself, because I don't want to pay somebody else when I can, you know, have my money go that much further doing it myself.
Absolutely. Absolutely. I wish I knew how to do a bunch of stuff. I don't know how to do anything.
I've kind of learned a lot by trial and error and YouTube videos. YouTube videos are amazing.
It's awesome. I know. I could probably build a house with a YouTube video, probably.
Actually, there was an article done by someone who did just that. It was a woman who didn't have a lot of money, and she did it all by herself. And every time she came to a step in the process, she would check out the YouTube video for what to do next. And she would also consult with her code inspector, you know, to see what the next thing they were going to be inspecting on. But yeah, that's what she did. She actually built her house using YouTube videos.
Nice. Interesting. Very good. Very good.
So, but wow, that's a wonderful program. I really like
it.
That
is.
one. So.
I'm trying to really bring it to the attention of realtors, even homeowners, but, you know, real estate agents when they're selling, you know, a house that maybe needs work. I mean, I think it's just a win-win.
Right, because you always find, especially in older homes, and not even that older. I mean, we're talking even like from the 80s. You know, you have that really ugly bathroom, or that really you know, hideous kitchen, or you know, people want the open layout, so they want to be able to knock down some walls, or you know. So so having that option is great. Wow. And what about for, say, like mobile homes, or do like tiny homes? Do they have?
Yeah, you know, FHA will do mobile homes.
Okay.
But they have to be what is that you call it? Like not with wheels. Like it has to be
okay. It has to be like permanently attached, basically.
Yeah. Okay. So it's like a mobile home, but like attached or modular or whatever. So they will do, and it's the same as a regular loan.
Oh, okay.
I mean, you have to have a VIN number in the paperwork and in the title and all that. But yeah, they'll do that.
Okay, great. Does it have to be? I know. Way back in the day, my first house was actually a mobile home. And I remember I had a hard time getting financing because it was 20 years old or was
Oh,
approaching 20. I
yeah.
think it was like 19 years old, but it was like right there. And so they really didn't want to give it a loan. They wanted to do it more like a personal loan. It would have been,
Yeah, like a car loan almost type
I think it was
thing.
like, yeah, 12 or 13, I can't remember, 12, 14%, somewhere in there. And I ended up getting
Yeah.
owner financing for 10%. I jumped on it because, it was just, it
Yeah,
was
that
cheaper
makes
than getting it
sense.
through the bank. So
Yeah.
is it still an age limit on the mobile homes for most financing?
Age limit? Oh,
Yeah.
yeah, on the, I'm thinking on the person. I'm like, no, not
Yeah.
on the person.
Yeah.
Just on the actual
Uh,
mobile home.
on the mobile home. Yeah.
You know what? I'll be honest with you. I haven't done a loan for a mobile home in a long time, so I
Okay.
wouldn't be able to tell you that. And I'm
Oh,
assuming it would because when they get up there in age, they they
right. They
start to wear.
depreciate. Yeah.
Yeah,
So, and like I said, I remember at the time it was 20 years. That was like the cutoff. They wouldn't do any financing over 20.
yeah.
So they
You
were
may
almost,
be right, and I want to say that makes sense, but
mhm.
I'm not sure.
Right. Yeah. Yeah. So, um, okay. I think, gosh, I'm trying to think if there's anything we have not covered. Oh, refinancing. We haven't really talked about refinancing at all. And I know too, and I want to touch on it really super quick before we get too far down the other rabbit hole, but you actually had a really great video on your page the other day, and it wasn't refinancing, which, I can't remember now what you were talking about. You know what I'm talking
Was
about
it
though?
the mortgage
The
modifications?
modification. Yes. Yes. So
Yes.
is that like a refi or is it something completely different?
So here's the thing. So remember a few years back when the mortgage crisis in 2007, 6,
Mhm.
5, all these years.
Yep.
So
Yeah, when the
when
bubble burst. Yep.
exactly. So when all that happened, mortgage modifications was the thing. Everybody was trying to get their loans modified because many people had, you know, adjustable rate mortgages, and they came to change and they went up, and nobody could afford their mortgages, and the entire country was upside down pretty much.
Mhm.
So what happened was that a lot of the lenders did modifications. So what happened is, and by the way, to get a modification back then, you could not be current on your mortgage. If you were current on your mortgage, they wouldn't consider you because you could afford it. So
Okay.
most people stopped paying their mortgages.
Hmm.
And when they stopped paying their mortgages, then is when the banks would start to work with you. Some banks, by the way, because some banks didn't even care. They just didn't, it was chaos. But
Hmm.
that's basically, everybody realized that to get a modification, you had to stop paying your mortgage. And I say this with a little hesitation because there's always going to be somebody saying, well, I didn't stop paying, but that was like the general consensus, and that's kind of how
Right.
it happened.
Hmm.
So what happened is that people ended up, let's say they did get a modification. It took years. Some people took years to get modifications. And I was one of those, by the way. I did get a mortgage modification. And it took a lot, like the banks would take years to modify your loan, 2 years. So
Hmm.
all these people had not paid your mortgage in 2 years.
Wow. So you stopped paying it. Now you didn't have to worry about being like foreclosure or anything like that during that
Yeah,
2 year
you had to
period.
worry about that.
You
You had
still
to worry
okay?
about that. You're not, you don't know what's going to happen. You don't know if they're just going to, but it was such a crisis that, I mean, it was just taking long. So they would work with you to get a modification. So let's say you went through the modification process and you finally were granted a modification.
Hmm.
So all that time you didn't pay for your mortgage, let's say 2 years you hadn't paid for your mortgage. There's people who didn't pay for 3, 4, like tons of time. So you do
Wow.
your monthly mortgage payment, multiply that by 12 months, and then multiply that by 3 years.
Hmm.
They get that number and they add it to the back of your mortgage. So if you owed, like, say, 100,000, and now you didn't make your mortgage payments, and you owe now another $45,000, just to give you a number,
Hmm.
and they added it to the back of the mortgage. But when they added that and they did the numbers, they're like, oh, you don't qualify for this mortgage payment.
Right.
So the only way they found that they can make you qualify is that they extended them to 40 years rather than a 30-year mortgage.
Oh, okay.
So they gave you more time, and then the payment kind of made sense.
Hmm.
So when I had this one particular customer and he sent it to me, and he's like, oh, I don't know if it makes sense, whatever. And we were looking at it, and I'm like, oh, you have 33 years left on your mortgage. And I'm thinking, what? And then it took me a minute. I'm like, wait a minute. And it clicked. I'm like, of course, you have a 40-year mortgage because you were part of the modification crew. And I'm
Wow.
like, just even if you refinance at the same exact rate, you're taking 3 years off.
Mhm.
But now with the rates how they are, he was like at a, at a 4 or something, and we were going to down to like a 3.5. It made all the sense in the world to
Mhm.
refinance. So, I mean, it made me think like, okay, people should know this because there's so many people who still are paying that modified existing mortgage.
Right. Wow. And especially if you're trying to, look forward to retiring or the kids going to college
Oh,
or
yeah,
anything, that's
yeah,
just
that's a,
wow.
yeah, for sure. And then, if you really think about it, a lot of, time has passed, the market has improved, things are
Mhm.
different,
Right.
employment, people are working, the values have gone up, and people, they have debt, and that's one other thing, and we can do that another time, but
Mhm.
to do like a screen share to see how, it's not only the interest rate. If you could take off, like if you can wipe out some debt, like I did one of some friends, they're friends of mine and my clients, and they had like, $40,000 in debt. We
Mhm.
did a cash out refinance, paid off all that debt at 3.5 or 3.75, some crazy number like that.
Mhm.
And the amount that they were saving monthly was like somewhere like $900. So then we're like, okay, we're not gonna get that $900 and be like, okay, we can go to dinner every night. No, now you take those $900 because you've been paying for it for years. You have the money, you make the money. Let's grab those $900 and let's pay it towards your mortgage every month.
Right. Yes.
The math and we did the numbers, it took away, I want to say 11 years off of their mortgage. So they would pay that mortgage
Wow.
off in
Mhm.
like, I don't know, 15 years versus, so I mean, I have a program that we can look at that, and that's pretty cool. It's pretty interesting. It's pretty motivating. You want to be like, yes, I'm going to do this.
That would be, yes, I know. And I know just for me, just by paying I took my monthly mortgage payment divided by 2 and paid it every 2 weeks when I got paid. And
Yes.
just from doing that little thing, so you're basically paying one extra payment a year. I
Mm-hmm.
shaved it from 30 years to 25 years just by doing that.
That's awesome.
So, and you don't even notice it because you're
Yeah.
paying your mortgage every 2 weeks.
Yeah. It's the same thing. Exactly.
Yeah.
Yeah.
Yeah, so it's not much at all. So but that's a great tip, especially so everyone go and check and see if you have one of those mortgage modifications. See how long you have left on your loan and your rate, because between the interest rates changing and that whole mortgage modification program,
Yeah.
those two things could make a huge difference.
Yeah. I was so excited. My video, I look like a crazy person. I'm like, oh my God.
Yeah, I did see the mortgage modification one. I was just like, whoa, that's crazy. So yeah,
Yeah.
that's just it's hard to even fathom.
Yeah.
Now at what point, if somebody, is there like a certain threshold level interest rate that somebody's paying where they should consider a refinance at this point? Or does it just depend on by the person and the individual
Well, it just really
circumstances?
depends on your goals and what you
Okay.
want. I mean, if you have a 3.5 and you have no debt and you don't want, I mean, it's not obviously won't be worth it.
Okay.
But if you have some debt, there's people who are not comfortable with rolling in their debt into their mortgage. And I
Mhm.
get that. I understand that. But it also, for me, if you look at it, it depends on, like if you're in your 40s, 50s, and you have all this credit card debt, you have some
Mhm.
equity on your property, and you owe 25 years on your house, but you want to retire at some point, or you have other goals,
Mhm.
or pay down your mortgage. I feel like if you take away those monthly payments of all those debts that you might have, credit cards, and
Mhm.
there's a lot of people with a lot of debt,
Right.
and you roll it into your mortgage. However, but this is the key thing. It's a great idea, but if you are not disciplined and you make that additional payment towards the mortgage, you can get back into debt.
Right. Yeah.
It's just matter of fact. But if you're that person who you really are determined to get to that point and you want to retire early and you don't want to have a mortgage payment, you kind of want to chill when you're
Mhm.
retired, and that's what I want to do.
Yeah.
This is a way to look at that. But if you
Mhm.
know that you're not that person, I would say not to do it.
Right, because I know we have had some people on here asking about, doing loan consolidation. So that would definitely be a way to do that, where they're getting a much better rate than they would through a loan consolidation company.
Yeah,
And as long as they have the discipline to
to
not
do it.
run the
Yeah,
balance back up on the credit card. That is always the caveat, because it's so simple. It's so easy to do. You
it is
start by saying, oh, I'm
It
just
is.
doing this one little thing. I'm going to buy this one little whatever. And the next thing you know, you
Yeah.
run the balance back up. And so now you have the higher mortgage and
Hmm.
credit
And
card debt back.
yeah, and then
So
that's a problem.
Yes, definitely. So,
Mm.
and that's why I always advise people to treat your credit card like a debit card and just pay it off every 2 weeks when you get paid, because that
Yeah.
way,
Yep.
you don't have to worry about the balance.
Yeah. It's
So,
hard. It's tough, to get to
it
that
is.
point.
Yeah.
It's almost like it's it's hard because you need to live and you need to do things, but it's I like to try and live like if I didn't have credit cards. And
Mhm.
I have one because I my history, I don't know, I don't think you and I have ever gone into it, but I went through bankruptcy. I went through a very long divorce with debts, all kinds of debts, like terrible. So I had to for many years live with no credit cards because nobody I didn't have any credit cards,
Mhm.
and I couldn't apply for any credit cards because I had bad credit. And I had come from this person who had amazing credit. I had American Express. I had a beautiful car. I had all the beautiful things and but then I went through a big divorce, and the market crashed, and everything went haywire. So I kind of had to re-establish myself,
Mhm.
and I had no choice but to go through a bankruptcy, and it's tough because that's tough emotionally and it's tough, financially. But I
Yeah.
really had to learn to live with no credit cards.
Mhm.
And it's been a while, it's been some years now that I have that, and I do have a credit card now, and
Mhm.
I use it, and I know that if I have, like a commission coming in or whatever, okay, I know I'm going to pay that off. But I
Mhm.
can see where, I throw away all the because I get so many that they want to offer me cards, and it's very
Oh,
easy
yeah. Yeah, I
to
do the same thing. I'm
give
always like, I'm
people more.
very strategic of which credit cards I choose to,
Yeah,
to
yeah.
apply for, because it
Mhm.
is, they love sending you, they'll
Yeah.
send you credit cards when you have no income. So,
Yeah, yeah. I mean, I think the 0%, 6 months for 0% is a great tool if you want to pay off
mhm.
debt and you want to take that and say, okay, I'm going to take. And the way that I've, helped people is I'll say, okay, I start with the smallest debt, pay
Mhm.
that off, and
Mhm.
start with the smaller ones because it seems like an uphill battle when you start with the biggest one, and then
Yeah.
start with the small ones and do 6 months, zero interest, and start there.
Yeah, I actually, and I don't know if you've ever seen this one before. It's a slight variation on that, but I actually take the total balance and divide it by the minimum payment, and whichever one has the smallest ratio is the one you pay
Mm-hmm.
off first, because then you are actually paying off the one that's going to cost you the most. And it
Got
just
it.
happens that when I did this not too long ago, I actually was playing around with this, and just kind of see where I was at now, and all that kind of stuff. And it actually turned out that the two smallest balances happened to be the two that had that ratio where it behooved me to pay them off the fastest.
Oh,
so
okay. Got it.
so yeah, so pretty much anything that's under a 40%, under a 40, anything under a 40, you really want to pay off as quickly as possible.
Mm-hmm.
Um, Doing this method, because the things that tend to be higher, like for example, when I looked at my mortgage, the ratio was 102. And
Okay.
so that's actually one where I'm using my money for me. I'm able to you're leveraging it better.
Yes.
So for anyone who likes to do math, like I said, you just take that, um, you take your total balance, your total current balance, divide it by your current minimum payment,
Mm-hmm.
and the one that whatever has the lowest number is the one that you want to pay off first.
Oh,
So it's
never heard of that.
yeah, I actually read it. I'm trying to remember. I think it was Ramit Sethi who might have. Uh, I'm trying to remember if it was him or yeah, I probably shouldn't give credit to anyone, because I'm probably giving credit to the wrong person. But but yeah, I heard that and I checked it out. I was like, "Ooh, this actually really works. I like this." And
Nice. Good
you know,
idea.
and it makes, because it really sets you up so that really you're paying the highest interest rate first, is what
Huh.
but it isn't always the highest interest rate, that is, because some cards just charge you more for a minimum payment, and
Hmm.
so, or maybe less for you, so you end up paying more interest. So
That
really
makes sense.
it's
Yeah.
like, for the long term, the one that you're going to pay the most on over time is the one
Hmm.
that gets paid off first, which I thought was a very interesting way of looking at it. So
I didn't even know that. That's
yeah.
good to know.
Yeah, and actually, it's funny because you're talking, after my divorce too. I was $30,000 in debt, and part of that was a car, so I was able to sell the car and
Mhm.
wipe out part of it right away. But I did the same thing you did, where I just started off with the smallest balance, paid it off, and then took that amount and started applying it towards the next smallest one. And, same,
Yeah.
because
Mhm.
that's what, what people did,
Yeah.
20, 30 years ago, and what our parents did and what our grandparents did. So,
Yeah.
it's been the long-standing advice is to start with the smallest one.
Yeah.
It's yes, but thank you for sharing your story with us. I really appreciate that,
Oh,
because
of course.
it's good to know that you've been where we've been. We're all. It
Oh,
seems like we all go
yeah.
through the same learning
Yeah.
cycle.
It's funny because people sometimes think, like, it's funny because remember, I have customers who come to me and they're like, "Oh, I had a bank." They're ashamed, and I get it. It's not fun to tell people you went through bankruptcy because that means you failed or something went wrong or it's messy.
Right, or
But
even just to have
so
debt right now. It's like there's such a shame and stigma around having any kind of debt.
yeah,
It's like it's
yeah,
something that we almost. I can't tell you anyone I know who is gone through life without ever getting in too deep in a credit card, or
yeah,
buying that car they really probably shouldn't have, or
yeah,
it's we've all been there. So I don't know
yeah.
why there's such shame and stigma
Yeah,
around it.
yeah.
So
There's no shame in the game. We've all been there. We're working through it, and it's just what happens. You get older, you get a little wiser. You start to think of long term, and what you want to do. You don't want to work till you're 100. I mean,
yeah.
you just relax a little bit, and you start to put a little bit more value on other things like time and that type of thing. So
Yes, yeah, yeah, and building your legacy and all that fun stuff. So,
hmm
well, thank you once again. Thank you so much. I know we're approaching the hour mark, which I and tell people in the event that I put it a half hour for the event, but I knew we'd probably go closer to an hour because there's just so much to talk about.
I know,
So,
I
if
know.
someone has more questions about this, what's the best way for them to reach you?
They can message me on here. I'll make, I guess I'll in the post, I'll make a comment. They can come to my mortgage page. I always put mortgage information on there. I try and come on there almost, a couple times a week and talk about whatever mortgage trends are happening, money trends, anything that I can find of value. They can reach me there.
Okay.
Or I can give an email address too.
Okay. And do you work throughout the United States, or are there only certain states that you work in, or how does that?
Yeah, I only work in Florida right now. I'm
Okay.
not licensed anywhere else. Thought about it, but I'm not sure if how I'd get business in any other states. But for right now,
Well,
I
just like this, I suppose, right?
I guess
So,
because what I do, I just know people locally here, and that's how I get my business.
mhm.
Word of mouth and referrals and stuff like that. So I thought, well, in a different state, how would I do that?
Okay. Well, we do have some members who are in Florida. So
Oh, cool.
I suppose if you're living in the state of Florida, or if you have a property in the state of Florida that you are curious, definitely reach out to Miriam and, ask her. Maybe she'll show you that really cool tool that she has to,
Oh yeah, I
to
love
take
that
that deeper
tool.
dive.
Absolutely,
And,
absolutely.
and definitely follow you on Facebook. Are you on any other social media channels, or just
I
Facebook?
am. I'm on Instagram
Okay.
under it's Miriam Gilmore Loans,
Okay.
and on LinkedIn, and my new favorite TikTok. Sorry, I love it.
I have not tried the TikTok yet. So,
I absolutely love it. I'm addicted. My kids are like, get off, but I love it.
and are you doing more videos like you did the other day, where you're doing your impression? I shouldn't say it
Oh my
wasn't an
God, yes.
impression, but you let your inner
Sophia Vergara.
whatever out. Yeah. Well, I don't know. I call that thing because you're yourself. You weren't trying to be her. I know that, but I heard. I was
No,
just like, oh my gosh, you sound just like her.
well, no, it's what it is. It's like her speaking, and then I'm just mimicking her.
Oh,
Yeah, so that's what kind of like
okay.
it's on TikTok. So it's dancing, and I mean, there's people who have business tips, and I plan to put some business tips on there too. But for now, I'm just having fun on the side.
It's more fun. Yeah, I've heard it was more for like challenges and things like that. So I didn't
Yeah,
realize they were actually doing like
it's pretty
serious
interesting.
stuff there.
It's there's a lot of people on there. It's pretty interesting.
I might have to check it out then. So far, it took
Let
my
me know if you
daughter
do.
leaving the state before I even got on Facebook. So, but thank you once again so much for joining us. Please, like I said, anyone reach out to Miriam, ask her your questions, follow her on Facebook, Instagram, LinkedIn, TikTok. Have her talk to you in her her full on Latina voice. That was amazing.
That's funny.
So when you do your dancing on TikTok, are you dancing like Shakira?
What did I do? No, so I do these challenges. I do it with my kids, and it's hilarious. It's just a lot of fun. You can just find me on there as Miriam Gilmore if you want to have a laugh.
Okay, because you have Cuban roots, if I remember correctly,
Yeah.
right? Okay,
I do.
so
Yeah.
that's so cool. You have so many more moves than I would ever dream of having. So I'm just like right there. I bow down to you. So, but
Music gets you going.
oh my gosh, I love it. Yeah, ever since I listened to the Pitbull channel
Oh, that's
on
funny.
Pandora, and so I
Yeah.
have, so I'm always listening to like, Daddy Yankee and Shakira and Carlos Vivos and you name it. I'm all over all those, and so and you just can't help but dance. The
Yeah,
music
it's
is
fun.
just. And I visited Miami. Oh my gosh, a gazillion years ago. It's actually been about 30 years now, almost
Oh
30
my
years. It was
God.
91. Got the worst sunburn of my life on Miami
Oh,
Beach.
probably. Yeah.
But I remember it just being it was such a vibrant party city. And one of these days I'm going to get back there.
Well, when you come back, we'll
I
go out.
absolutely loved it. Okay, sounds good. But I'm going to have to do like in the wintertime when I don't burn to a crisp. Because I think when I went in like, I think it was April. It was either April or May. And I was
Yeah.
just like,
Yeah, it's always hot
completely.
here. It doesn't even matter what you get up. It's always hot.
So, but once again, thank you so much for coming on. I really appreciate it, and have a wonderful night. And thank you, everyone. We'll talk
Thank
to you all soon.
you. Bye.